Thanks, Adrian. Morning, everybody. Welcome to the start of another week. August. August, we know what happens in August, or we know what doesn't happen in August. Morning, everybody. Hi there. Hi there. Steve, Jeff, thanks so much, James. The start of a new trading week. It is August, as I said at the beginning of this piece. It's typically markets are a little bit thin. A lot of people take their vacation, especially in the States. Our holiday period is really mid-July through to the sort of first week in September. But typically the markets are a little bit thinner at this time, and I'm sure it hasn't escaped your notice that the trading bands are particularly narrow at the moment. That's not always the case. You'll have heard us talking over the last couple of weeks about what happened this time last year, and that's one of the reasons why it ain't going to happen again this month, this time of year, because last year the markets were a little bit wrong-footed. The politicians and central bankers sort of waited till everyone was on holiday before attacking them. But believe you me, the politicians and central bankers are on message this time round, so I don't expect too many sharp moves. And I agree with Adrian, actually. I think what's going on, what typically happens is, we all know the bad news. The bad news is in the market. When we say in the market, we know about it. You and I, we've discussed it. It's discussed in the press a lot. So there's nothing new coming out. And you think, well, why is the market going up? Typically, what happens when there's no bad news, it's taken as good news. I know that sounds a little bit weird, but no news is good news. So for the time being, without any sort of further wobbles, and I know Greece has got this repayment, 3.8 billion repayment that's been negotiated with the European Central Bank, that's going through. Generally, you get a little bit of sort of continual buying of the markets. When I talk about buying the markets, a little bit of risk-on trade seeps in, or covering of risk-off trades. We've discussed this before. A risk-on, i.e., when investors, money managers put money, increase their risk in the market, they buy equities. Equities are deemed to be more riskier than bonds, and they buy commodities, and they sell bonds. When it's risk-off time, quite the opposite occurs. When managers, investors are fearful, they put their money into safe assets, and those safe assets are typically the core Eurozone bonds, the German and to a lesser extent French bonds, UK bonds and US bonds. So that's an explanation for those of you who have joined us more recently about risk-on, risk-off. But I, like Adrian, do think, though, that it's only a matter of time before we have to start readdressing the situation. And I think we have to get used to narrower bands at the moment, I'm afraid. And that's what August is about. The ranges are tighter, and you just have to get used to trading those tighter ranges. But please, make sure you have applied the same discipline, the same rules. Just because the bands are narrower, nothing else has changed. The interpretation is exactly the same. You just get used to trading, as I say, a lot narrower. The daily ranges are a lot tighter, as I'm sure you'll have appreciated by now. Okay, let's just open up a browser for me. I think Adrian has already done that, has he? Okay, yep. Let's just put up some of the headlines so we can see what's going on. I'm just opening up the FT page. Let's get our Forex calendar factory page up so we can see what's going on in the news. Okay, just a quick review of what happened last week so that you're in the picture. Generally, the data was a little bit disappointing, poorer than forecast. If I go to our Forex calendar here, you can look at any week you wish for the data. We're on this week's data. This is the week starting Monday the 20th. But if I wish to go back and look at data from the previous week, if you look here on the left-hand side, I can click Show Week, and that shows me what was happening last week. Interesting just to note, because a lot of the data that we were looking at last week was poorer than expected. The key economic sentiment, ZEW economic sentiment indicator, 25.5, minus 25.5 versus a 19.4 negative number, worse than expected. The only bright point last week were the retail sales in the US, which were surprisingly higher than expected, as we discussed last week. Other than that, the Empire State, the manufacturing indices, that's the New York State, the Empire State, minus 5.9, expected 6.6 plus. So that was a significant undershoot there. And so was the key Philly Fed one on Thursday. That came in at minus 7.1, expected at minus 4.7. Why, James? Yes. Why, if the markets and the data, if the data is particularly poor, why are the markets doing what they're doing? Well, I think the markets are still waiting. We've had this Draghi comment that they will be buying bonds and that, believe you me, it will be enough. We've got all that ringing in our ears. And I think there's a lot of expectation. As we said 3 weeks ago at the beginning of August, the paradox is now you've got potential QE in the US, potential QE in the UK, and even, QE of sorts in the Eurozone. So some of the part of the irony is that the fact that the markets now are not bothered about poor data, it just reinforces the chance that we are going to get some sort of intervention by any number of central banks to prop up the markets. So that's the backdrop, really. Overnight, well, we've had comments from one of the ECB's policymakers, a chap called Asmussen, has stated that a Greek exit from the Eurozone would be manageable. It's quite what messages that's sending, I don't know, but it's preferable that the nation remains in the bloc. God, talk about stating the bleeding obvious. But I was listening to Wake Up to Money this morning, and they had the chief investment officer from Fidelity, I think it was him, who was saying that it would be pretty catastrophic, obviously, for a Greek exit. It would really cause severe disruption in the market. And I think that is something that is a big concern, especially because of other things that are going on. And I'm clicking back onto the FT just to show you, if we look in global economy, there's a comment about the Chinese. Economists weigh a Chinese hard landing. Now, if you want that to put into plain English, when we talk about a hard landing, the Chinese economy has been extraordinarily strong for a long, long time. And in terms of what's going on in the global economy, the Chinese economy has been the one very bright spot out there. And it's something that is a concern. And obviously a lot of the fingers pointing at the Eurozone for some of the problems in China. But there is quite a cooling off. And for the time being, they believe that it has been a manageable sort of soft landing. When they talk about a soft landing, i.e. a gradual slowdown rather than a hard landing, which is where, the data, it all falls off the edge of a cliff, really. And it is a little bit worrying. I mean, what some of the data I've seen here, for example, I'll highlight it here. Economic expansion in the second quarter slowed to 7.6% compared to the first quarter's 8.1%. And and the country appears set to post its lowest annual growth rate since 1999. It needs extraordinarily high growth just to maintain the momentum. That's the problem that happens in China. So one of the big issues we've got now is trying to work out what happens if there is some sort of a hard landing in China, and what effect this will have on the rest of the world. A little bit worrying, bearing in mind you've got fairly anemic growth in the US and all these problems in the Eurozone. The last thing we want to be discussing now is a hard landing in China with the growth falling sharply. Not saying that's going to happen, but that's something that is under consideration at the moment. So there's the backdrop, and yet the market's sort of mixed, really. Just looking at equities, I've opened up the chart here. If we look at just a daily and a weekly, God, there are so many daily, monthly, weekly. So if we look at the FTSE. This is the FTSE chart. As you can see, the daily chart on the top, it's still trading quite nicely, but you can see now the tight ranges we're stuck in. So bit of a sort of an unchanged week for the FTSE, and indeed for other Eurozone indices. I think the Dow was a little bit steady. If I just put up the Dow, yeah, that closed a little bit up on the week, so slightly better than the UK. But again, look at the bars, very, very small bars, none of the sort of big impulsive moves that we get at normal times. So the ranges are a lot smaller. tradable though. There's a lot going on. Just adjust your sights, please, in terms of your sort of targets and objectives and stops. You know, you'll be trading in tighter ranges, but nevertheless, the markets are trending. Good, certainly for us in the short term, I should say. I'm talking about intraday. Obviously, if you're an end-of-day trader, there's not a lot to get hold of at the moment. Okay, and before I pass you back, let's quickly have a look at the data for this week. Not a lot really going on at this particular time. I'm going to flick back now on Forex Factory. We're now going to select this week. Okay, let's just go through it one at a time. Really nothing much on Monday, obviously. In fact, nothing. GDP, that's Rightmove's home price index. That's not out yet. That's not particularly important. It's the red ones we really want to be looking at. And with all due respect to the Australian, New Zealand economies, with data coming out in the middle of the night, all we need to do is to be able to read up about that data. And if you are trading the Aussie in the middle of the night, please be aware of any overnight data that comes out. Refer to this calendar, please, make sure. Public sector net borrowing requirement, PSNB, 9:30 on Tuesday. That's the first bit of data. But really in the UK, we're more interested in the GDP revision, which comes out on Friday. Okay, well, let's just carry on going through. The next bit of key information, we've got the FOMC minutes. I'm sort of skipping, really. There's nothing on Wednesday other than that. There's the regular crude oil inventory. So if you trade crude oil, remember that 3:30 data, weekly data. Don't be surprised if you get a sudden movement in crude oil, heating oil, and any of the products, because obviously those inventory stats do have a bearing on that market. But other than that, one of the key bits of news. Why are we interested in the minutes? Well, why do people want to know what the ruddy meeting's talking about? We like to know what the result of the meeting is, and we heard about that a couple of weeks ago when they released their statement as to what they're doing with interest rates, etc. If you remember, there was no press conference and there was no news at all, but it's interesting to know quite what they're discussing, and to have an insight into those minutes is quite important, and it's also very useful for us in the UK. We get the MPC minutes as well, so it gives us an insight into the thinking of the members of these committees, and they are incredibly powerful. If you think about it, you know, what they say and do affects everything that we trade. Currencies, bonds, commodities, equities. So it's really important we know what these guys are thinking of. So 7 o'clock on 7 o'clock on Wednesday evening. Obviously, as I said, no change was made in that policy at the last meeting, and we think there is a very low chance of any QEs. So, as always, the markets is continually looking for some sort of suggestion from the FOMC, the Federal Reserve in the United States, as to whether they're going to be increasing QE. Next bit of data, unemployment claims 130 on Thursday. Really very, very stable at the moment, clicking around the sort of 365, 370,000 claimants. So no surprises there, really. Thursday at 2 o'clock, 3 o'clock, we love new home sales. We like the housing market is key. The housing market is key in the UK, believe it or not. It's key in the US. They say for every house that's built, it creates 5 jobs in the US. We say 3 jobs over here, but nevertheless, it is a big employer. You know, you buy a home, you buy white goods, you buy carpets, you employ carpenters, etc., etc., etc. So it's quite a key part of the economy, and it's a great barometer. It tells us whether things are going to be ticking up. If there are a lot of new home sales, housing starts, even more important, or even building permits, even better. Good leading indicators telling us what's going to be happening. Friday, okay, we've got the revised GDP number. Now, there's been a lot of discussion about the surprise number that we had, the recession, deepening with the last GDP number reported at minus 0.7%, which was quite a bit worse than we were expecting. Most economists believe we're going to get a revision to minus 0.5%. May even be slightly better than that. I've got to say, the evidence does not suggest that we're in a deepening recession, really, and I think a lot of this was distorted by the extra holiday in Q2, sorry, with the Diamond Jubilee. Finally, a very important bit of data, probably one of the most important bits of data this week, core durable goods, that's non-food items. Very important number to watch. After the sort of non-farm payroll, it's a really key number. And it looks like companies decreased their orders for long-lasting U.S. factory goods in June, suggesting that businesses are less confident in the economy. Here we're looking for a slight tick up, though, in July to plus 0.5%. So maybe this slowdown has been reversed a little bit. So, U.S. economic growth prospects, once they have been dented with the Eurozone crisis, I think, as we've always known, and the data has always consistently shown, that the U.S. economy is doing considerably better than the Eurozone as a whole, albeit it's gone slightly anemic over the last few months. Okay, that's really what's going on this week.